All right, thank you all for joining us. Today's presentation, Leaving a Legacy, is going to be about financial planning and estate planning strategies for transferring your wealth, both to heirs and also to charities. And we are glad that you're with us. And before we get too far into things, I just want to give a quick disclaimer that none of the information that we're providing today should be constituted as specific legal or financial advice, as we don't know your background. This is really for educational purposes only. So today's presenters, I'll go ahead and introduce myself. My name is Brooke Anderson. I am a financial advisor with Kaizen Financial Advisors, and we provide basically a suite of services, including retirement and life planning, portfolio management, basically anything that has to do with your life, financial life, we get involved with. Lifelong financial coaching. We're here to help you navigate. Everything that you hear in this presentation today are things and topics that we cover as part of our practice. And I also have joining us today, and I'll let Yvette introduce herself here in just a second, but I just want to say Yvette is someone that we have used with our clients to develop estate plans, and she's done a great job for us. So we're happy to have her on board also. And Yvette, I'll let you introduce yourself.
Hi, thank you, Brooke. My name is Yvette O'Connell. I have a solo practice, a small office down by Green Lake. I do mostly just estate planning and probates and trusts, and working with clients to make sure that their plans are complete. And we'll go through all the different documents that we go through, but that's just a little bit about me.
Great, thank you for joining us. I appreciate that. So before I just jump into topics for today, I just want to take a second and just say that I want to thank Housing Hope for sponsoring this event, and just say how proud we are to partner with them. And I've had the opportunity to hear the mission and understand how they are helping meet the housing needs of our community. And we're just grateful for what they do. Great people, great organization. And we just are grateful that you are part of the Housing Hope organization. So with that, I want to tell you a little about what we're going to talk about. It's going to be basically broken into three parts. Tax law, exciting stuff, but it's really the basis for how wealth gets transferred or donated. It really is driven by the tax codes. I want to talk about some of those basic tax laws that are in place. Then Yvette will jump into estate planning. We'll talk about some myths and all the documents that she mentioned that really you should have as part of your estate plan. And then the third part is going to be on the transfer of assets. How do we optimize from a tax perspective the transfer to our heirs or to the charities that we want to sponsor? And then we'll kind of wrap it up with just a little bit about the value of professional guidance. There's lots of places to make mistakes, and we always hate to see it. We always usually hear people when they've made some kind of mistakes, and I always think, gosh, I wish I could have helped you beforehand. So we'll talk a little about that when we get there as well. So that's the basic agenda. And let's dive in. So I want to start with kind of what our typical client that we see in our wealth management practice. And I think a lot of people aspire to this same model. So we build our net worth to provide for ourselves in retirement. That's usually the base of our financial planning. It's how we're going to get ourselves through the rest of our life when we're not working. But a lot of us have ambitions beyond that. We want to help our kids. We see that a very common practice that people say, gosh, I want to leave something for my kids and leave them a better opportunity that I had, but we want to help in that transfer and how you might do that efficiently. And then we also have, because we deal with clients that have a little extra, that they really do want to make a difference in their community, and they want to have an impact on society. And that's why at the top of this triangle, I have leaving a legacy. And many of our clients aspire to do that. So again, we try to put in place and help guide them with strategies that will help them do that the most efficiently, and really just make that vision come true. And I always say this: proper planning goes a long way in achieving these goals. It can really maximize the size of this what we aspire to do, and we're just excited that we get to participate in that and see what people do with it. So that's a little bit of a vision. We're going to talk about how these two transfers occur and how to do them efficiently. So now, like I said, the exciting part, tax law. So jumping into it, the first thing, a lot of things are driven by your estates. This is just real quick. I want to just talk, what is an estate? An estate is really the value of everything that you own. So it's your personal financial statement. It's all your assets, less your liabilities. That would be your mortgage or any other loans you might have outstanding. And that difference is your net worth. That is the total value of your estate. It's going to be the basis of if a state is going to be subject to estate taxes, and both at the state and federal level. And it's the really our starting place for how we might guide a client in trying to drive that a certain direction before they ultimately pass. So again, the value of the estate is everything that you own, the net value. So I want to start with Washington estate taxes. Not everybody realizes that not every state has estate taxes. In fact, there's only about, I think it's 16, if I added them up right, states that have some form of estate taxes. And that's basically where, when someone passes, that value that we just talked about, that estate might be assessed a tax. And that is not a tax paid by the recipient, it's paid by the estate. So after they pass, the estate pays those taxes, and then whatever is left would go to the heirs of that estate. And just if you don't know, in the state of Washington, the first $2.193 million is exempt from any estate taxes. So no taxes on that first $2.193 million. After that, there's a tax assessed, and that is on the first million above that 2.19 million is a 10% tax. The second million, so let's say I had a $4.193 million estate, that second million would be taxed at 14% and so forth. So if I had a taxable estate at my death of $5.193 million, that would mean $3 million of it is subject to estate taxes in Washington. That would be about $390,000, a big tax bill. So anyway, that's generally how the estate taxes in Washington state work. And we're going to talk about ways to avoid these. For 99.99% of Americans or Washingtonians, they should never pay this. There are strategies to avoid that. The second estate tax that we want to touch on is at the federal level. So we just finished with Washington, that's Washington only. Now we have at the federal level, the first 11.7 million, a big number, is exempt from any estate taxes at the federal level. Then after that, you're subject to a similar scale that we just talked about, although it really only covers the incremental next $1 million. And you can see as the rate climbs from 18% to 40% being the highest bracket for $1 million or more. So if you had an estate that was $12.7 million or more, all the dollars above that are being taxed at 40%. On the right, I thought it was just kind of interesting for context to show this kind of gold colored bar or line is showing how the maximum tax rate has decreased over the years, at least since kind of the mid 50s, has been on a decline. Now we're down at 40% as the maximum rate. But what's also happened is that exemption, that 11.7 million, has been rising since the Great Depression, basically. And that's this blue line. You can see how it's increased over time. By the way, the blue line refers to the dollar amounts on the left axis, and the maximum estate rate is on the right-hand side. But you can kind of see those trends, just sort of interesting to note. But again, that's for very large estates. Very few people qualify for that, as you can imagine. It's a very small percentage. So now we know those exemption amounts. I want to talk on something that's a very important concept in estate taxes and mitigation of them. That is something called portability. And what portability is the ability to transfer that exemption, because those exemptions, by the way, were per person. If I didn't mention that, it's a per person exemption. But what happens when one person passes away, say one spouse, and gives all their money to the other? Do they lose the person who passed away because the person who's still living still only gets their single person exemption? If you could preserve the deceased spouse's exemption, that would be called portability. And at the federal level, that's the large amount, that 11.7 million, there is automatic, or I shouldn't say automatic, there is portability granted by law. You just have to fill out a particular form with the IRS, Form 706. Not that most people care, but that's the form that you would fill out at the within 9 months after death, and you'll be able to pass on your 11.67 million to your spouse. What about the state of Washington? No portability. And by the way, a lot more people, as you can imagine, are going to get tripped up by the Washington state tax limits, because that limit was so much lower. It's a little over, it's 2.2 million roughly. Well, a lot more people are going to have 2.2 million than are going to have over that 11.7 million. So many Washingtonians have estates that are in excess of 2.2 million. And don't forget, it's all your assets. That includes your home or your life insurance policies, anything that's going to contribute to your estate. So there's no portability in the state of Washington, but there's all sorts of things you can do. There are things, I should say, you can do to preserve your spouse's portability through a trust, and you can also avoid those taxes altogether by some other strategies we'll get into a little later in the presentation. So that's the concept of portability, important when we talk about estate taxes. We'll talk and touch on trust today too. And a lot of people have a misconception that trusts are a place that you can park money to avoid taxes. Not true. Trusts can oftentimes preserve the exemption in the form of a kind of a legal portability, if you will, that's created by a trust, but it doesn't minimize trust. In fact, if you have a trust and that trust is its own entity, it files its own tax return, the tax rates are actually outrageous on trusts. And I'm kind of showing you here, if you kind of imagine your own personal tax rates, imagine hitting the highest tax bracket at only $13,000 of income. In fact, down here, I've got actually at the bottom, you can see the comparison of the rates if you're single, married, filing jointly, head of household, estates. You can see how much more punitive estate tax rates are. You do not want to earn any income in an irrevocable trust, because that irrevocable trust, which files its own tax return, will pay those high rates. So if you do have an irrevocable trust, and there are many reasons to set one up, you want the income distributed out of the trust and never recognized by the trust. Those are things that obviously your estate plan attorney would be working with you on, but just be aware that a trust is not protection against taxes. It can preserve exemptions, but it can't reduce your tax rate. So that's kind of the gist of trust. We're going to talk a little more about trusts and some other area high worth individuals to do that. And so I just wanted to highlight that here. Not a whole lot I want to dive into deeply there, but I want to point out that it is an unlimited deduction for estate tax purposes. And then wrapping up the tax section of this presentation, I want to touch on some tax proposals. As everyone knows, we just went through an election, and with new leadership, we tend to see new ideas around taxes and all sorts of things. Well, there was a number of proposed tax changes that were put forward by Biden before the election. We don't know what's going to turn to law, and we don't know what will pass and what won't, or how they'll be amended. All we have is a list of what he proposed. And so I'm just going to mention some of them, and this does not mean that they're going to occur, but I'm going to highlight two of them in particular because they have a big impact on gifting and giving and whatnot. The first one is he's calling for the repeal of the step-up in basis. What this means is mom or dad bought Microsoft stock at the IPO, and it was worth 10 cents a share. Today it's worth, let's say, $140 a share. When you inherit that, you inherit today at the high stepped up basis. Your cost is in essence going to be the $140 a share, not the 10 cents that mom and dad paid. So when you go to sell those shares, you'll have to pay capital gains tax on whatever the value from your basis to whatever price you sell it at. And if you get that stepped up basis, you're not going to pay tax on all of mom and dad's gains. You're going to pay tax only since you inherited it. That's the step up in basis. That has been proposed to be repealed, which means you would accept mom and dad's cost basis on those stock shares, or the value of the home, or anything else that you were to receive as an asset. The next one I want to highlight, the second one that's in the box, that is to restore the gift and estate tax limits. As I mentioned, it's 11.7 million, a very high number. And remember how it's only gone one direction since the Great Depression, 100 years almost, is to get larger. They're proposing to have the first decrease in that exemption amount. The number that's been called out is 3.5 million from 11.7 million. That's a per person number, and you do get portability with a married couple, so you can double that. That'd be 7 million for a married couple if you file the right form. But the point being is that's a dramatic decrease from where it currently is at, which means it's going to nab a lot more people. So if those were to go through, it would change the strategies of possibly how you might gift or how you might pass money to heirs. So I just want to highlight those two. There's a handful of others, but I'm not going to dive too deeply in those right now. But there are other things that might change that as well, but those are two of the most impactful. So that kind of wraps up what we're going to talk about from a tax law perspective. We kind of skimmed over a lot of it, but I think we touched on the highlights, the biggest drivers of how we plan for giving and charitable gifting. So with that, I do want to turn it over to Yvette, and Yvette's going to talk about estate planning and some of the myths and documents and all that. So with that, I'm going to turn over to you, Yvette, and I will flip the slides so you can certainly just let me know whenever you would like me to change those slides.
Thank you, Brooke. So yeah, like Brooke said, I'm just going to kind of talk over what it's like to get an estate plan done, what documents we go over, and all the little facets. So let's start with this first slide. We're talking about some basic myths that people might have. So I'll let you read those over, but I'll highlight a couple of them. The first one is I have a lot of clients that come into my office that they want to avoid probate. They're not sure why. Maybe they've heard it from a friend or from a radio talk show, but they want to avoid probate. And in Washington, probate is very streamlined. We have a very simple process. The cost is very minimal. In Washington, in King County, it's $240 to file a probate, whereas in California, they might take a percentage of your entire estate. So it doesn't matter if you have $1 million estate or a $20 million estate, the court is only going to take the $240. So of course, the complexity of your estate would drive the cost of your probate with your attorney, but otherwise there's really not a need to avoid probate in Washington. Let's see, another one I wanted to touch on was intestate laws. So I wanted to just say, what is intestacy? So if you do not have a will, the state of Washington has laws that provide a will for you. So let's say you're a married couple and you have children. Well, any community property is going to go to your spouse. If you have any separate property, half of it's going to go to your spouse and half of it's going to go to your children. So what's separate property? Separate property might be property you brought into the marriage, or maybe it's something you inherited. So that might be fine for you, but let's say you're a single person and you have some assets and you have no will, no spouse, and it's going to go to your parents. Or if your parents are gone, then it's going to go to your siblings. And if you have different ideas of how you want your estate plan to go, then you might want to write a will so that you don't have the laws of intestacy directing where your things are going. So in general, you just kind of want to have the peace of mind, let you decide what you want to do. I had a client come in just a few months ago. Their brother had died tragically, and he had a fiance, never had an estate plan done, and he had some assets, but because he had no estate plan, everything went to his mom. So his fiance wasn't taken care of at all. And I'm sure that's not what he wanted, but that's what we have. His 90-year-old mother with dementia is now inheriting all of his assets, whereas fiance is getting nothing. So she's, there's a lot of hurt going on there. So it's really good to have an estate plan and get these things done. Okay, we can move on to the next slide. Okay, so the core estate planning documents. So when someone comes into my office, these are the documents I'm going to go over with them. A will, powers of attorney for healthcare and for financial. And we're going to go over a healthcare directive, also known as a living will. And then I do one more also. It's just disposition of remains. I want to have a complete package. I want you to know, like right down to what are we going to do with you after you die? What do you want done with your body? So let's just, I'll go over these really quickly. So with a will, like some that Brooke touched on, we want to have a complete picture. We want to make sure that what you want done will actually be able to happen. So there are probate assets and there are non-probate assets. Only the probate assets are going to come through your will. The non-probate assets are going to be items like your life insurance that has a death beneficiary, or your IRA with a death beneficiary. Those are non-probate assets. So let's say, for example, you have, I have a client that comes in and they want to give $50,000 to Housing Hope. and they have everything else going to their daughter. They have plenty of assets. They've got, let's say, a $200 IRA, and they've got a $35,000 bank account. So there should be plenty of assets to take care of that. But if I just write that in the will, there's not going to be enough money, because the only asset that's going to go through the will is going to be the $35,000 bank account, as long as the daughter hasn't been listed on it. So the IRA, if it had the daughter listed as the beneficiary, then that would go straight to her after the client's death. So what I would recommend is, say, split that IRA, take $50,000, put it into a separate account, and name Housing Hope as the beneficiary for that account, and then have your daughter for the rest. And then in the will, we just put in the daughter. We don't even mention Housing Hope, because they're already taken care of through the IRA beneficiary designation. And it's a win for them too, because when you're distributing a traditional IRA, whoever inherits that IRA, they are going to pay the taxes at their income tax rate when they take a distribution. Housing Hope is going to take it tax-free. And like Brooke said, it's going to come off the top of your estate. So it comes out of your estate value. So it's a win-win to name a charity as a beneficiary on an IRA. And you can certainly go to your financial institution and ask them to divide your IRA. There's no problem with that. You can have more than one. So that's one way we kind of like to have a full plan for when someone comes in for especially with dealing with a will. The other documents, power of attorney, medical and financial, that's really important. Just you're assigning an agent that can act for you during your lifetime. And if something were to happen, you have someone there. So there's two ways a power of attorney becomes effective. One is immediately, so the moment you sign it, it's effective, or it's only upon incapacity. And that's where a doctor needs to sign a note saying that you don't have your capacity. So people feel different ways. When you give someone the power immediately, you're not taking any of your own power away, you're adding on someone to help you. But if you don't feel comfortable with that, then you can do that only upon incapacity. But it's important to have someone there just as a backup. The healthcare directive is the next one, and that's basically saying, do you want to have life support if you're in a terminal situation? And when I'm talking to my clients, I really look at this as a guilt alleviator. So you've appointed someone as an agent in your healthcare power of attorney. And so if you cannot speak for yourself and someone has to make that really hard decision as to whether or not to put you on life support, they can at least look at the directive and they can say, okay, this is what he or she wants. Like I had a client come in over the summer, nice guy, he did all of his documents with me, and his brother called me in the fall. He had died suddenly of a heart issue and had spent 10 days in intensive care. And his brother thanked me for putting together the healthcare directive, because it gave him peace of mind that he was doing what his brother wanted when they decided to terminate the life support. So really hard things to do, but this kind of helps alleviate the guilt for those people that are left behind. Let's see, what else? Oh, and then the disposition of remains. Like, what do you want done with your body? It's a really good conversation to have with your friends and your family, whoever's going to be taking care of those matters. And most importantly, I really like, if you're going to be cremated, tell people what you want done with those ashes, because otherwise they're just going to sit. My mom died. She didn't care what happened to her ashes. So we still have her ashes 10 years later. If she had said, take me to Hawaii, take me to Lake Washington, we would have had the peace of mind that we were doing what she wanted. So even if you really don't care, do something for your family and kind of alleviate that guilt and let them know something so that it will go on. Okay, we can go to the next slide, Brooke. Okay, probate. So probate, this is the process after someone dies. We're administering an estate to make sure that all the assets can be transferred and they get to where they need to go according to the will. So in the probate, we get a personal representative appointed, and this used to be called an executor, but this is the person that's going to administer your estate, pay taxes, clean out your house, pay your bills, close out accounts, and then distribute your assets. So you want to have someone that's organized and that you can trust. Let's see what else about probate. Probate isn't always needed. Usually when you have spouses, the first spouse to die, there's no need for a probate, because usually everything's community property here in Washington, and it just kind of shifts right over to the second spouse, the surviving spouse, so there's no need. But when the surviving spouse dies, then we might be looking at having a probate at that point. Yeah, I think, well, I can go into more. So there's a few ways to avoid probate. That might be a transfer on death deed. So some states have transfer on death deeds. Washington is one of them. So if you have real property, you can actually put a transfer on death deed on to transfer out that property. And you can have beneficiary designations on your accounts, like your IRAs or your life insurance. Those will avoid probate as well. Okay, we can move on to the next one. Okay, trust. So a trust, it always sounds really complicated, but it doesn't need to be really complicated. A trust is basically a titling of an asset. So if someone passes away and their child is going to inherit via a trust, it could just be a Fidelity account or a Vanguard account or an account, managed by Kaizen, but it's just in the name of the trust. So it could just be a financial account. It can be a house, it can be in the name of the trust. And then there's a trust document that'll control what happens with those funds or that asset. The most common type of trust that I see is a trust for minors, and it doesn't have to just be minors, it can just be children. But even if you have children that are young adults, you may still want to trust in your will. So if something happens, that money is kind of held by a trustee. So for example, if you have an estate that's worth $4 million and you have 2 kids and they're in their early 20s and something happens to you and your spouse, then are your kids ready at 22 to take on $2 million? Probably not comfortable with that. So it's nice to have a trust where you have a trustee that can actually manage those funds, invest them, and then give them to the children as they see fit. But you have just someone that you trust that's kind of holding the purse strings and helping out. Trusts also help with creditor protections and just making sure that the kids aren't influenced by maybe other family members to give them money. So it's just nice to have that buffer in between them and the money, even though it's still there for their benefits. The marital trusts, those are the trusts that Brooke was talking about earlier, about how to preserve your portability and to preserve your exemption amount in Washington. So we do a lot of the disclaimer trusts or credit shelter trusts in Washington because it's so easy to be over the $2.2 million exemption amount in Washington, especially with the real estate. If you own a house, have an IRA, a life insurance policy, you're most likely in need of an estate plan with a trust in there. There's also charitable remainder trusts where you have, I have a client whose wife passed away and her children, not his, he set up a charitable remainder trust for them. So the kids get, they're adults, they get a stipend every year. And then after they pass, whatever's left is going to a charity. So that's a really nice option as well. Okay, we can go on to the next slide. And that's okay. That was it. Thank you. I'll turn it back over to Brooke.
All right. Okay, I think I'm back on. So thank you for that. So now we're going to go into this third part of the presentation, which is talking about transfer strategies. That's both to our heirs and to charities. And I'm going to start with talking about lifetime giving. And this is kind of where we talked about that idea of never paying the Washington state estate taxes. There's something, so if you wanted to give to your children, ultimately, let's say or to charities, you can give more than the annual gifting limit, which is $15,000. Lots of people have heard, oh, I can only give away $15,000. Really, it's not true. You can give away more than $15,000. You just have to claim it against your lifetime giving. How much lifetime giving is everyone allowed? 11.7 million, the federal exemption amount. So you can give that amount away over the course of your life. You're not limited to 15,000. The only issue is you would have to claim that if you go beyond 15 and you don't want to pay tax on that, which you will if you don't claim it as a lifetime gift, you need to file a form with the IRS saying I'm tapping into my lifetime giving and I'm giving away more than 15,000. And what they'll do is whatever that, if I want to give $1 million to my son this year, I can give him $1 million. I fill out the form. And when I die, instead of giving 11.7 million, I'm only going to get 10.7 million. So I'm tapping into it today. Great news is Washington State does not do a look back provision when they assess. They don't say, oh, you had $5 million and now you only have 2 and you're under the limit because you gave your son $3 million. They just look at it at the point of death. So it's a great opportunity before you get there to gift to your children or give to charities prior to the end of your life. at least in the state of Washington. One great way, if you don't want that to hit that limit, you might as well give that to the people you ultimately want to have that before you pass. Obviously, sometimes if we get hit by a bus, we're not going to know that date, but a lot of people in older age will take advantage of this and do this because they know they're nearing their end of their life. So the first part of giving effectively, I'm going to talk about giving to our heirs. And I refer to this as gifts as opposed to donations, but in gifts, that's giving to our heirs. Some strategies, we're going to talk in two parts: during our lifetime and then upon death. During our lifetime, we have the ability to give away $15,000, no questions asked. We can also give more than that if we tap into our lifetime giving amount. As I just described, I can give any amount up to the federal exemption as long as I file the right form and I lose that exemption later in life, but I can give more of it today if I want. That's during my life. Another great way to give is to give direct payments to education. Maybe I've got a niece and I want to pay for her schooling at Harvard and it's $75,000 a year. I could make a direct payment to the school and it totally surpasses. I can do the same thing for medical, make a direct payment for that, for my same niece for a very expensive medical bill, and I can exceed those limits. And you're not subject to those caps if that's the way I'm donating, direct to the institution, the educational or medical. Also, when you're giving and you're giving to your heirs, your children or something, you might want to give the gifts with the lowest unrealized gain. So very little gains, because you're passing on the capital gain to your child when they receive it. They're going to pay gains on it. And unless you're in a lower bracket or something of that nature, you might as well give to your kids the lowest gains securities, so stocks. It'll be just the opposite when we get to charities, but for giving to your kids, you give them with the least amount of gains. There's also family partnerships. I won't go into a whole lot of that. And there's irrevocable trust. We talked about that is not a way to lower tax rates during your life, but again, I just wanted to touch on that because again, a lot of people believe that there's ways they can give to their children more advantageously and avoid taxes via a trust. And again, it's more for the preservation of that portability than it is anything else. What about on death? So on death, what can I do? Well, inherited assets do transfer with a step-up in basis, at least in the current tax code. So that's a great gift to your kids. Everything they receive, that's their cost basis. So hopefully there's no capital gains on any of that if they were to sell it the next day, and they can do with it as they please. Upon your death, your estate is subject to the Washington estate taxes and federal taxes as they're described. So again, I come back to that. You can give away unlimited amounts to charity. Excuse me, unlimited amounts of charity, which is a great way to reduce the value of your estate. But again, be aware that those estate taxes are applicable. And then just again, revocable trusts do not circumvent estate taxes either. That's where I might have a living trust or something where I can change it throughout my life. That never caused the assets to leave my estate. They're part of my estate because it was a revocable trust. So the only way you get something out of your estate is an irrevocable trust. And that's where you'd see like the credit shelter trust that preserves portability, and those are irrevocable trusts. I will just point out too, there's new rules around inherited IRAs. They're less advantageous. For sake of time, I'm not going to go over that in gory detail, but there were some tax laws that caused you to now recognize transferred IRAs in a much faster rate than was previous. Now I'm going to talk about donation strategies. So instead of gifting to your heirs, you're giving to charity. And we'll break it down in the same two buckets: during our life and upon death. During your lifetime, just the opposite of giving to your children, you want to give away securities that have the highest unrealized gains, which means it's those Microsoft shares that you had at the IPO that you paid a penny a share, $1 a share, whatever it was. Now they're worth hundreds of dollars. That you will avoid all the capital gains by giving those shares away, and the charity that receives them pays no capital gains. So you basically exempted the capital gains burden from those, the capital gains tax. So that's the direction you want to give when you give securities. I also want to talk about bunching just briefly. For those people that don't itemize on their taxes and they don't give away enough each year to take advantage of the ability to deduct and get a deduction for their giving, you can actually bunch. And what that means is you're giving, think of it an every other year donation. Every other year, if you're going to give it Christmas time, give all your gifts on January 1st and then December 30th in the same year. And all of those giving will be applicable for that calendar year. The next year, you give nothing away. And the following year, you go back to a January and December gift. What you're doing is you're bunching them up every other year. And every other year, you're qualifying for the deduction, even though if you spread it out evenly, you might not itemize and you might not get any benefit for your donation from a tax perspective. That's the concept of bunching. Directly giving from your RMDs to charity, that's a great way of instead of taking your and these are required minimum distributions when you're IRA, when you're over the age of now 72. It used to be 70 and a half. That might be a number you're more familiar with. But if you're giving, if you give straight from your IRA, that RMD, excuse me, you never recognize that as income. And that can actually reduce your AGI and it makes other things deductible. So a little bit of an advantage. Donor advised funds, I'm going to touch on that in a minute in a little more detail. Employer matching, like Microsoft, that gives matching dollars. There's no greater way to have an impact on the charity than getting employer matching. That's where a charity or the company may match dollar for dollar what you give to a charity like Housing Hope. If you're a Microsoft employee, they would match that contribution. That's, again, great. What about on death? So on death, if you designate directly within your will, as Yvette mentioned, you could put that, hey, I want that $50,000 gift. Yvette made a great point. It might make more sense to put that into an IRA or some other transfer by law asset that doesn't go through your will. Again, on life insurance, IRAs, 401ks don't pass through a will, they pass by law. So again, they avoid the probate process, they avoid passing through your will. Well, if you didn't have enough to give to the charity that you wanted to, you'd want to specify in those other accounts. But again, you can directly identify with beneficiaries within your will to be charities. That's great. Charitable life estates, actually, that's just a form of ownership. I could co-own my house with Housing Hope, and when I pass, my house becomes owned by Housing Hope. Charitable remainder trusts and lead trusts, we talked about those briefly. That's where you want to provide some maybe benefit to your kids or something while they're still alive, and you want that either the remaining balance, or you want the charity to get the interest and your heirs to receive the lump sum at the end of that someone's lifetime or something of that nature. So there's a lead trust or a remainder trust. Those can be set up through your attorney if you want to give in such a way where you're retaining some value until a future event occurs. And those are remainder and lead trusts, but those are both available. I want to this chart looks a little daunting. I'm not going to go into real depth on this, but I do want to touch on a couple things. You don't get to claim unlimited deductions for your donations. If I give away cash, the way to read this chart, if I give away cash to a public charity, which is most charities that we're familiar with, I can give away 60% of my adjusted gross income. That could be tax deductible. If I give away 70%, I can't deduct that amount. Now, I do get a 5-year carry forward, so as long as I can carry it forward to the next year and get credit for it, but I won't get credit for it in that current year. And one thing I want to point out too, and this has burned a few folks that I've seen, where short-term property and long-term gain property are two separate things. Short-term is when you own an asset less than a year, if it's stock or if it's an income-producing property like a bond. It could be the income is ordinary income. But let's talk about stocks. Let's say you bought Tesla in March, and it's up something like 1,000% since March. And I decide, hey, I put in $1,000 and now it's worth $10,000. I want to give that to Housing Hope. And so you turn around and you gift it to Housing Hope. The IRS is going to say that was going to be a short term. If you gave it at December, we'll say you gave it at Christmas, you only owned it for 9 months. They would say that's a short-term gain. How much do you get to deduct in your taxes? Only what you spent on it, $1,000. You don't get to deduct the $10,000 it was worth because it's a short-term gain property. You should have given that away 2 months, 3 months later, and you could have deducted $10,000 for that gift. So you want to be strategic in how you're giving. And I won't go over all the details of these, but there's limitations usually at the 20, 30, 50, and 60% of gross adjusted income. If you're giving sizable amounts, you'll want to know what's deductible and what's not, what carries forward and what does not. One thing I do want to touch on briefly, public charities, non-public charities. There's most of the charities you've heard of or probably involved with are public, but you'll notice there's lower limits when you talk about private charities. So you might say, well, how do I know what I'm giving to is a public or a private charity? You can do it on the IRS's website. I've actually put the address right here. You can look it up. So I just decided to look up Housing Hope for fun. And what did I find when I ran that analysis? It says, are they listed as a public, as a charitable organization? Yes. So this yes refers to, yes, it's charitable. What does PC right below it mean? Public charity. That means when I go back to my list, I can give away more than I could if it was private. So it's a way, if you're ever not sure, you can check. And I, again, just did the check for Housing Hope and they do qualify. Last portion I want to talk about, because it's been very common, we're seeing a lot more of these. In my practice, we're seeing a lot more of folks who are utilizing a donor advised fund for charity. And I just want to just touch on kind of what it is. It's basically where you could put a sizable amount of a donation in an account today, still subject to those the donation limits we talked about that are deductible. But again, you got 5-year carry forwards. You might want to spread it out over a period of time. But let's say I drop a big lump into a specific fund that I want to dole out over the next 10 years. And you might say, well, why would this ever happen? I have a client who actually received a $1 million bonus one year. And that would be the best example I can think of. I got a $1 million bonus. I'm in the highest tax bracket. If he's charitable, he could drop a portion of that into a donor advised fund. And he'll get to deduct as much as he's allowed to deduct. But now he recognizes that all this year, but that far exceeds what he gives in a given year. So now he's gonna take that donor advised fund and dole it out over the next 5 years or 8 years or whatever he would normally do. So it's just an advantage. It's a way of providing a benefit today because you got a big lump of money. We usually see this occur when people get large sums of money in the form of large bonuses or stock payouts, those type of things. And that's when you generally see it. We're seeing more of those come along. And so I did want to make mention to it. Again, I would get professional advice before you do so. There are some downsides, like they do cost money. They're irrevocable. They're not protected from the bankruptcy of the sponsor. So if I did it through Fidelity and Fidelity went bankrupt, it might be at risk. I'm not saying that they would go, but something to be aware of. So there is some positives and some negatives. Make sure you get good advice before you end up taking advantage of that. So that was kind of wrapping up the strategy on giving. I know that there's a lot of detail in there, and if you certainly have questions, we're going to leave some time to entertain those. And if you're not on this live, you can obviously reach us. We're going to leave our contact information. I'd be happy to share some thoughts with you if you have any of these things that have raised questions in your mind. And that kind of gets me to this idea of professional guidance. We talked a lot about different strategies that have different levels of complexity. Doing them incorrectly sometimes can be worse than not doing anything at all. And whether it's donor advised funds or picking which assets you want to donate or structuring your estate plan to optimize how you're giving and how you're gifting to charities, all those things, you want to do it right. And making mistakes can be costly. I'll just share one interesting little story because it came up yesterday. I had a phone call from an individual who's, unfortunately, his mother passed away in the summer, and his father passed away 5 years prior with really no estate planning, gave his estate to his wife, not surprisingly, and she passed with a little bit more than $5 million. And he's the executive of the estate, he's doing all the math and looking at it, and all of a sudden he had this kind of sweat on his forehead, and he's saying, oh my gosh, I didn't realize there was an estate tax in Washington. So that was a little bit of a surprise. And every year his mother had been gifting the maximum amount, $15,000. That was it. She left her estate equaled more than $400,000. The taxes on that estate in Washington are going to be a little over $400,000. There should not have been a single dollar had she done some planning in advance, had gifted more heavily, And she certainly wanted to. She didn't think she could. And she didn't think she had any options for doing that, and didn't realize that she could have saved the portability of her late husband by doing, again, some estate planning up front. So I just share that as an example. We see mistakes made all the time, unfortunately, but I just can't stress more. If you want to do it right and you want to do it efficiently, get guidance where it's complex. If it's simple, that's fine. If it's not, get the right guidance. And Yvette, if you wanted to jump in here on anything, you certainly can. I don't know if you had anything you wanted to add to that or not, but it's certainly something that we see mistakes made. And again, I know that even for our clients, we don't try to tell them what to do on a estate plan. Actually, we refer to people like Yvette, and she helps guide them along to structure things properly. I don't know if you had anything you wanted to add to that or not. But.
No, I've had situations like that too, where even among spouses where, they didn't gift out or they didn't set up a trust and realize that they could have saved on estate taxes just by simply having a trust in the will where the spouse could use the exemption. A lot of people don't realize, they think, well, there's a $2.2 million exemption, so our estate's under 4 million, so we're fine. But what they don't understand is when the first spouse dies, the second spouse is left holding more than 2.2 million. So then when they die, they've got an estate tax issue because they're holding the whole bag at that point.
Mm-hmm. Yeah, no, great point. Great point. So one thing I just want to leave you with, this is the last slide of our presentation before we see if there's any questions outstanding. I'd just like to share it, because to me, it's a good visual. We spend a lot of time, energy, and effort accumulating wealth over our lifetime. I think of our blood, sweat, and tears in our jobs, and we save, and we pinch pennies where we need to. We build our net worth over time. And I kind of think of this concept of we're filling up a net worth bucket. All your assets you're accumulating. And unfortunately, everybody's bucket has leaks in it. It's just how big are those leaks? Leaks come in the form of maybe you're paying too high of investment fees. You have inefficient tax strategies. Maybe you just have bad financial habits or suboptimal estate planning in place. There's all sorts of things that cause leakages in our net worth. And one of our jobs, and I know Yvette has the same vantage point in that we're trying to do everything that we can to make sure those leaks get plugged, and that you're not just overlooking opportunities to not let that leakage continue. And like I said, some of these are bigger than others. I think of those, that poor, I'm actually having lunch with them tomorrow, so who knows, Yvette, I might be having an estate plan referral for you for the siblings, because again, they had no idea that they needed to do something. That's this suboptimal estate planning, and there's all sorts of areas in which we just continuously drain our net worth. So I just encourage you, if you have questions, need any kind of advice, to reach out to someone. Certainly myself and Yvette, we're available, but reach out, get professional advice where it's needed. With that concludes our presentation today, and we wanted to leave the last 10 minutes of this hour open for questions. And I don't know if there are any questions, but we can leave it open for a moment. And I don't see. Okay, I don't see any questions out, and I'm looking at our message board. That's why I'm not looking at the screen. I apologize. But I know that Nate from Housing Hope would like to close things out. So I want to invite Nate. Thanks for joining in, and we'll let you close things out. And again, I'll just kind of leave this up here with our contact information. We'd be happy to answer any questions you have. So please don't hesitate to reach out.
Yeah, well, I just wanted to, first of all, say thank you so much, Brooke and Yvette, for taking what are some potentially overwhelming, scary, I don't know where to start types of subject matter, and really providing that perfect high enough level overview that it's we get a lay of the land, but without going too much into the details, because of course everyone's situation is different. So you clearly both are very experienced professionals, and I'm just incredibly grateful that you've given your time today to share this wealth of information. And that is our hope in having these seminars every 6 months or so for Housing Hope supporters is, I know just from statistics nationally that there's a large percentage of us who don't have estate plans in place. It's just one of those things that we know we need them, but we think, well, I'll do it tomorrow, I'll do it next week, I'll do it next year. and good intentions, but no plans in place to do that. So our hope in our heart in providing these is to offer a thank you of sorts, to create a safe space for you as a supporter to be gently nudged by being empowered with information to so that as you pursue whatever estate planning professionals, you have some knowledge in your brain, so you don't feel like I'm scared of getting taken advantage of, or I don't want to appear stupid, or whatever fears might keep you held back from taking action for your household. That with the wonderful information Brooke and Yvette shared today, you'd be empowered to take action. Of course, we would as well love to have you join our Society of Hope. That is our group of supporters that have said, we're taking care of our family and we want to take care of Housing Hope family a little bit. And so supporters in the Society of Hope have left gifts anywhere from $5,000 up to much more. And that's just a special group that we have, and we pre and post COVID, we assemble and gather together to provide an intimate setting to hear what Housing Hope has been up to. And those estate gifts, unless designated by the supporter, those go into our Child Hope program, which helps children who've experienced the trauma of homelessness to overcome that trauma and have a healthy, productive life. So that's, I think, a beautiful way to take something that is about the end of life, our estate plans, and to know that it's being invested in perpetuity into future generations, leaving a legacy that way. So besides nudging you to take care of your family, we would certainly welcome conversations and inquiries about leaving just a small part of that estate to Housing Hope and our Child Hope program. So with that, that's just the end of my bit. Just want to thank you again, Brooke and Yvette, for your time today. Thank you, supporters, for tuning in live or watching this after the fact. Hopefully you've got a nugget or two to take action with, and reach out to Brooke, Yvette, myself, Tim Foley, if you have other questions about Society of Hope or estate planning needs. Hope you have a wonderful day. Thanks again for your time.